Hello, welcome, Self-Made Nation. Colleen O'Connell-Campbell here, wealth advisor at RBC Dominion Securities and your host of the Cash Rich Exit podcast. Employee ownership. Employee ownership is becoming a powerful exit option for founders who want both liquidity and legacy. Our guest today is Chad Friesen, CEO of Friesen's Corporation and president of Tallgrass Employee Owner Equity Fund. We'll together explore the Friesen story as a model for employee ownership, the real economic ripple effects this creates in the community, and how those insights have shaped the Tallgrass Fund's mission to help more founders exit in a way that protects people, purpose, and prosperity. If you're listening or watching on YouTube and thinking about your own cash-rich exit and what that might look like, reach out for your one-on-one wealth gap analysis. It's a practical way to see what you need from your business to fund the life that you want after your exit. Okay, let's meet Chad. Welcome to the Cash Rich Exit podcast.
Hi, Colleen. Happy to be here. Thanks for having me.
Excellent. Now, before we even dig into the topic of the day, which is employee ownership, you are representing a Canadian company that's been for a long time in an employee ownership structure, but I think it's helpful to sort of share a little bit of the backstory of Friesen's and how it's come to be in employee ownership, because I think it's a wonderful example of what can happen.
Absolutely. We wouldn't have a future if it wasn't for our past. And so one thing I want to get out of the way for your listeners, Colleen, is my last name is Friesen, but I am not a member of the original Friesen family that started Friesen's Corporation way back in 1907. And so we've had five leaders of this organization over the history of the company. All five of them have had the last name Friesen. The first three were actually part of the original Friesen founding family, and the last two were not, but both named Friesen. And so there's a little
Fun fact. Yeah, there's
fun
a
fact. We'll start with a fun fact and
yeah.
end with a fun fact.
Yeah,
So
Jeopardy or Trivial Pursuit, or one of those games could include that as a interesting question, right?
you bet. Yeah,
Mm.
exactly. So we're a about $120 million company based in Southern Manitoba. And we've been around for many, many years, as I've already mentioned. Um, but we're not dissimilar to a lot of companies scattered all across Canada, and so I wanted to emphasize that. But one of the unique features or interesting points of our company is we are a large international company operating in a very small community. So Altona, so the immediate community surrounding us is 4,500 population. And so that has some great benefits, and it has some very significant obstacles or
Hmm.
challenges to it as well. But we've been here our entire history of our company, and we operate three businesses. We have a trade book. All three businesses are linked to print, to books, and to storytelling. And so our tagline or our
Hmm.
mantra is that we help others share their best story with the world. And we do that through print mostly, but also through some publishing services. And so our main business, our core largest business, is in the trade book space. And so we work with the largest publishers in the world to produce many of the titles that your listeners would find in any chapters or
Hmm.
uh, on a coffee table somewhere. Anything that you can think of as sort of big reads, that would come through our trade book business. We also work with some of the smallest publishers in the world, but we cover the gamut. And then our second business is also books, but it's a very different customer. And so we work with schools and universities across North America to help them produce their school yearbook. And
Hmm.
in that business, unlike our trade book business, where we work with professional long-term publishers and designers, in our yearbook business, we always joke that our publishers always graduate every year. And so it's a business of
Constant
re-educating.
turnover. Yeah.
Exactly, right. And so
Yeah.
we're constantly retraining students and teachers in how to publish a book, and which happens to include hundreds of students that are trying to mark their point in history. And so that's a very different business, very
Hmm.
similar product on the back end, but a very different business at the front end. And then our third business is a publishing services business called Friesen Press. And in that business, we work with authors that are seeking to self-publish. And so if you have a story to tell and you need some help getting your story edited, designed, copywritten, distributed, marketed, basically everything that you can think of involved in publishing,
Hmm.
we're the guys that help with that aspect. And so in that business, we work with somewhere around 1,000 new authors every year. And that customer base is very different as well, right? And so these are people that are intimately involved in the story,
Hmm.
and it's essentially their brainchild that they're trying to bring to market, and so it's a high touch, high service type of relationship where we will work hand in hand with an author to get their story out to the world.
I like the way that you describe it as, basically the sharing of stories as opposed to strictly the physical books, right? Because
Mm,
the power of a book is really the story. All the books behind you. I was showing you my bookcase before we got
yeah,
started. Yeah, fascinating. And um, really, it started as a one person shop
yeah,
and has evolved into not just a one person ownership, but fully all the employees are owners. Like, why don't we
yeah.
dive in? I've had a number of guests on the podcast at this point now
I got it.
over the last year, talking about employee ownership trust, employee ownership. So maybe like as the next step in the story, like what was the impetus for the original founder, the Mr. Friesen of the early days, to
Yeah,
want to go down this path?
yeah. Well, and so it's interesting when I talk to people about ownership, I can tell them that we've been owned in many different forms over our entire history, from the sole proprietor at the beginning
Hmm.
to a family owned, exclusively family owned business, to an ESOP, to a hybrid ESOP slash EOT, to finally what we're owned as today is a 100% employee ownership trust, owns the company. And so I think that too has to have a little bit of history to it as well. So the three brothers that took over from the founder, so D.W. Friesen's three sons, all were very active in the cooperative movement, the credit union movement, and the mutual movement of the 40s and the 50s. And that, I think, was really the framing that set them on the path to employee ownership. They looked forward, and they saw that they were going to have a third generation of ownership in the original Friesen family, but that there was not likely going to be a fourth generation. And so that
Which is often a challenge. You get past
absolutely,
even past second generations, but certainly third and fourth generations, it gets more and more complicated to to have a family succession.
yeah, and they had options. So they had options to sell this company dozens of times. And so I always tell everybody I've got a file folder of history in my desk drawer of companies that have made offers, equity funds that have made offers to purchase the company. And so it's not that the family didn't have opportunity to essentially cash out and move on,
Hmm.
but they truly believed that the business played a greater role than simply in the original Friesen family, and so they very much wanted to share in the proceeds with the employees that helped build a company. They also wanted very much to continue the company for generations in the community in which it was formed. And so they were big community boosters, and they wanted to ensure that that economic spinoff would continue. And so that's really, I think, with the sort of the impetus to why we became an employee-owned company originally. And it actually started very simply. And so what ended up happening is, they sort of had the idea in the 50s and 60s, but really only started in any significant way, sort of 70s and 80s. And in the 70s, they were already often giving away shares in exchange, instead of bonuses, instead of necessarily pay raises, because the company couldn't necessarily afford to give monetary benefit in another way, and so they would offer up some shares to employees. And so it started at a very sort of natural progression, like many companies do, but then it really accelerated, and it was in the 80s that the family knew that there weren't going to be enough. The company was growing, and so share values were rising, and they knew that there wasn't always going to be the right ratio between new employees coming in that were willing and able to buy shares,
Right.
and exiting owners that had to sell their shares when they retired. And so that was at the point when they started the first Friesen's Employee Trust was in the 80s, and it was essentially supposed to be sort of a market of last resort, where essentially the company funded the trust. The trust had some cash, and then the trust would go to employees that had to retire, and it would, if the employee couldn't sell their shares on the open market or the employee market, the trust would come in and acquire those shares with the sole intention of redistributing those shares at some point back into the marketplace.
So I was going to say that the market really was only other employees, but only the employees that could actually afford to buy the shares. So
that's right.
Okay. So that was that would be what, like the third iteration sort of thing? Is that when when the trust was brought in? So there were some shares that were given out as by way of compensation in lieu of direct pay.
That's right.
And then there were shares that were there new shares issued, or was it just then any shares outstanding could be bought by another employee, and then the trust came in? Like, how did that work?
So there were definitely different share classes, and over time there was many attempts to try and instill broad-based employee ownership in a market where there was still a buy and sell function to it. And so there was a time when instead of paying out a dividend, let's say, or making a profit sharing payment, let's use that term, instead of using paying out a profit sharing as cash, the company would instead pay out a profit sharing as Class B shares. And so they would essentially, instead of receiving a check for $300, you might get $150 worth of cash and $150 worth of shares, right?
Okay.
And so there was that, several iterations through history of trying to really seed this idea that once you became an employee owner and once you actually own some shares, that you would want to continue to buy and to sort of get the pump primed on being an acquirer of new shares. And some of that worked splendidly. Like there was some folks that just saw that as an opportunity and took off. But there's also, I think there was sort of a generational shift along the way where, the idea of having cash now, instant gratification cash now, maybe the affinity of saving or investing in the future wasn't quite as broad-based as what we would like. And so what would end up happening is there'd be a portion of employees that would hold those shares, and there'd be a portion of those employees that would just flip them, and they would sell them for cash. And you could do that on this closed market. But it essentially came back to this idea that, there was a point where about 20% of the employees owned 100% of the company. And so it was employee ownership, but it was still somewhat concentrated in those that were either willing or able to acquire shares. And so that was one of the also one of the challenges. So now you fast forward into the 2000s, and
Hmm.
you've got this company that's done exceptionally well. So share values are rising
Concentrated base of
quickly.
owners.
Concentrated base owners aging,
Mhm.
right?
Mhm.
Aging owners that need to liquidate before they retire,
Mhm.
and a new generation that's coming in that doesn't have the same affinity to uh, investment, and just doesn't, quite frankly, have the financial wherewithal to buy all of those shares. And so now this trust mechanism that was originally set up as sort of a market of last resort starts to become a larger and larger and larger shareholder of the company.
Mhm.
And so fast forward to 2007, 2008, when we had the sort of what we would call the trifecta of
Mhm.
challenge that came at us was, the U.S. economy goes down. Uh, Asia is all over us from a distribution or from a supply standpoint. And the Kindle e-reader has just been introduced. And so there's a lot of nervous employee owners on the shop floor at that point.
Right.
And so that at that stage already, the trust was the dominant shareholder in the company. And so the decision was made to that instead of, so now if you're an employee on the shop floor, and you can see all these challenges facing the company, and it had been generations of security and growth
Mhm.
that nobody had really prepared for, some existential crisis. And so
Right.
now these employees that are holding these shares, the only people you can sell to
Are
are
there
the people that are on the shop floor right beside you, and they know the same challenges, right? And so the market kind of dried up a bit, and so then the trust became sort of just kept buying more and more shares. And so the decision at one point was made where we need instead of risking having employees try and leave the company in an attempt to liquidate,
right?
what we did is we financed the trust to buy back all of the shares from all of the employees, essentially de-risking the situation for them.
And the
And so,
company, really, because if you have
yeah,
all these employees leave the company in order for them to monetize and get funds off the table, then you lose all that talent and
yeah,
history and et cetera, et cetera. Like there's so
exactly,
many other
exactly.
levels.
Yeah, so that was essentially we kind of what I would say we sort of backed into being a broad-based employee ownership trust at that point, and it was sort of a you know a defensive measure rather than an offensive measure, uh, but it worked. And so over a 5-year period, the company could afford to pay off all of the previous shareholders. And it was an interesting transaction, right? Because you're going to an employee and you're saying, we want to buy your shares and we're going to pay you cash. Basically, we froze the share value for a period of
Hmm.
time, paid cash for the shares.
Hmm.
And by the way, you are going to continue to be a beneficiary of the employee ownership trust. And so you'll still receive beneficiary uh, benefit from the trust, and you're actually liquidating your risk at a personal level. And so we, I saw it as a win-win
Hmm.
situation for our employee owners at the time. And so that's essentially why we are an employee ownership trust today.
Right. And so we're talking, I mean, I got very interested in this area when the government rolled out regulations around formally giving some tax incentives to employee ownership trusts. But this was well after this was created for Friesen. So obviously didn't get to benefit from that. But if I recall correctly, I think you told me that some of the legislation was actually modeled somewhat after what was created for what your firm created
Yeah.
in essence for the employees. Tell me a little bit about that.
Yeah, and it is true. And so we worked with 4 people within the finance department that were tasked with building out the new EOT legislation. And so I think they benefited greatly from seeing Friesens as a case study. And so a lot of employee ownership concepts in Canada were still theoretical, and
Mm-hmm.
there are other employee-owned companies like Friesen's, but nobody that was really operating at scale in an EOT the way that the final legislation would be created. And so I think we became a bit of a, I won't call it a poster child, but sort of an example of how it
Mm-hmm.
works and evidence that it does work, right? I think
Mm-hmm.
more importantly than anything. And so we shared our indentures, we shared, how our structure worked both in governance and also in practice. And I think that influenced. They didn't take everything verbatim, but I think there was a very significant influence of Friesen's model on the legislation. And I think one of the things, Colleen, that I'll emphasize is, we're this EOT. So I said we kind of backed into it. So, but we also backed into some and realized afterwards some tremendous benefits that weren't part of they weren't the original objective, but they were certainly a very successful outcome,
A nice
which
side
is,
effect.
yeah, great
Yeah.
side effects.
Yeah.
And so the uh, the main one is the narrowing of the gap between those with privilege, or maybe with those that have access to capital and those that don't. And
Right.
so when we moved to the EOT, everyone in our organization, every employee participated, and there wasn't this major difference between those that could afford to buy more and those that couldn't. And it was I find a great equalizer. Not that everyone participates equally in the program, because it is we have and we can get into that later if
Yeah.
you want. We have different factors that influence that, but it really became everyone's in, and I think that was a very significant tenet that the federal government wanted to emulate as well, is this idea that it doesn't matter who you are, where you came from, that you have an equal opportunity to participate in an EOT. And I think that was probably one of the greatest things that we could give example of is, 40+% of our employees weren't born in Canada. They immigrated here, many of them with support from Friesen's, and they wouldn't have had any excess cash to invest in
Mm-hmm.
the company. But they became 3 months after joining the company, they became beneficiaries of the trust and therefore employee owners. And that would have never happened for many of them had it not been for the way that model was created. And so I think it's just a great. I think it was a great outcome from the transition that wasn't sort of the main purpose, but it was certainly a great byproduct of the exercise.
Right. And as far as, I guess, how percentage wise, or, I don't know how you describe it, but when it comes to each and every individual who works for the company that is a beneficial owner in the trust, um, how does that get calculated out? Is it hours? Is it senior? How many years of service? Is it a level, management, or, working the
Yeah,
floor? Or how is that determined? I imagine that you said factors. I was going to say it's some type of formula
yeah,
that is used.
yeah. So there's two formulas, and rightly or wrongly, we use compensation as our number one uh, proxy. And we do that because we believe that our wage scales are structured and reflect the value that individual employee owners or different positions will contribute to the organization overall. And so about 70 some percent of our maybe be a little bit higher than that. So I'd say 70 to 80% of our EOT distributions are based on a compensation formula. And so very high level we would take your last 5 years of compensation, the individual's last 5 years of compensation, and we divide that into the last 5 years of compensation for everyone in the pool. And so let's say it's your $50,000 of pay this year divided into tens of millions of dollars
Hmm.
paid over the last 5 year period. You divide that out, and that'll determine your percentage of that portion of the pool. And then the other formula is based on years of service. And so we take your total years of service and we divide that against the total years of service of everyone in the pool. And that determines your percentage of that portion of the EOT. And we do that because we wanted to reflect two things. One is we thought that the wage that was paid to the individual was the only and best proxy for the value that they are creating for the company.
Mm-hmm.
And two, the years of service needed to be in there so that you would give a recognition to the folks that have spent decades in the company versus somebody who's only been there for a short period of time.
Right.
And so it works. That works for us, and ultimately it fits within. The two is one of the models that I think the feds looked at to say this is how these formulas work. And so baked into the legislation is that guidance that it has to be either based on compensation, hours worked, years of service, and those are sort of the proven factors that we've used in our model.
And it's sort of a profit sharing idea as opposed to capital growth, or is it also a combination of those two?
No, I call it a dividend because
Dividend?
we used to have both. We used to have a dividend and a profit sharing model. So I'm very deliberate to just call it a dividend. Model. But I think that usually explains for folks that we're very deliberate about moving away from the equity component because our old model was equity based. And the challenge with the equity based was if you had been here long enough to get it, you'd probably stick around. But we would have a lot of our sort of newer staff. You'd continue to have churn because people wouldn't wait it out long enough. It was sort of we were in a period of time and we still are today where it's more of the what have you done for me lately type of work. And so we made the decision at that point to say if we're going to share value, we're going to share value in the moment. And so if you're an employee today, you're a beneficiary today, you participate in today's proceeds. And so we do what would technically be a dividend, but we call it EOT distribution. So we do 3 of them a year. We used to do 1 a year. We do 3 of them a year, mostly also to try and emulate a bit of a dividend announcement as well.
Right.
So that throughout the year, there's multiple points where we're sharing value, and it's not just a once a year event. It's throughout the year you get, how did last year go? How are we doing mid-year? What are our expectations looking at for year end, right? And so there was we've kind of staged some celebrations, and they're all tied to we get together. We mostly share food at that time, so we eat.
What kind of celebration doesn't include food? Come
exactly.
on.
But we get together, we eat together, and we actually still issue a physical check to every employee owner, and so they'll come by a table where somebody from the board of directors or senior management will hand the person a check and say thank you for everything that you do to be an employee owner, and so it's a very physical sort of recognition of the exercise, because it'd be simple to do a direct deposit into everybody's account, just like we do it with pay.
Yeah.
But we were very deliberate to try and make an event out of it 3 times a year.
So are all of your employees located in Altona? Is everybody in Altona? Okay.
No. So we have I would say somewhere around 100. We have 550 employees in total, and somewhere around 100 of them are distributed across North America. Most are Canadian, several are American, but the lion's share of the employees are either in Altona or at least in Southern Manitoba. So we have folks that'll drive in from Winnipeg. We're an hour south of Winnipeg, and so we'll have people that'll come in from Winnipeg or neighboring communities, call it sort of a 45-minute catchment in and around Altona. So we're really a Southern Manitoba company more so than we are an Altona right. Company. But yes, it's certainly concentrated here in this community.
So tell me what happens in the community around these quarterly dividend payouts. Anecdotally, what have you noticed? You were
Yeah,
telling me a story, I think, about the car dealership, I think it
yeah,
was.
yeah. Well, and that's very true. So when we do a check distribution or an EOT distribution, you can literally. I always tell people it feels Altona feels a little bit like a microcosm of a business that distributes wealth in this way to a broad-based number of people. You can almost literally feel the local economy get a little lift the next day as people start spending that money at the local level. And I just told you it doesn't all happen here in Altona.
Hmm.
And
Hmm.
so the larger we get and the broader, more distributed our employees get, it's a little bit less impactful because not everybody lives within the block. But it is literally, you can talk to business owners, retailers around the community, and they'll tell you that something obviously just happened at Friesen's because we're getting people through the door at a greater rate than we normally do. And I think the greater thing, Colleen, those are fun, and it's a really good story. But I think one of the more important aspects is we calculate somewhere around 60 to 80 million dollars of annual economic spinoff from
Hmm.
this company at the local level. And so I'm not talking about the equipment we buy in Europe or paper we buy in North America. Sort of 60 to 80 million dollars right at the local level. And if the original Friesen family hadn't made the decision to move us on the path to employee ownership, that that capital generated sort of economic flow would have left the community years ago,
Hmm.
and that's reoccurring year after year after year, and so it has been just a massive impact at the local economy, and you think about if let's say I'm going to say we would have probably been sold probably 20 to 30 years ago if it hadn't been for employee ownership, we probably would have been sold 20 or 30 years ago. And so you just think about the economic impact
Hmm.
that would have had on the Southern Manitoba, let alone Altona, over that period of time. And it's just massive the influence that decision has had on the local level.
Hmm. Um, and not to pivot, but I'm going to pivot because there's another aspect here. We've created this tall grass equity fund. Now, correct me if I got the name wrong.
Yeah, it's a bit of a handle. It's called the Tallgrass Employee Owner Equity Fund.
Okay, it had to have owner in there, right? But essentially, that has been created out of the experiences of building
Yeah,
out the structure at Friesen's. So, tell us a little bit about, I'm going to short form Tallgrass
yeah,
and
yeah,
who you're catering to, who you'd like to be helping to serve with
yeah.
Tallgrass.
Yeah, absolutely. And later, if you want, we can come back to, might be interesting to talk about some of our EOT practices at Friesen's as well. There might be some interesting stuff there too. But so after 2000, I told you about the trifecta of challenge 2007,
Mm.
2008, we had to make some changes. We were also predominantly a printing company, predominantly a book company at that time.
Hmm.
And from 2009 until probably 2015, the sale of printed books in North America dipped. And it did at the time. It felt like it was running off, and everybody, back especially in that early days, would have said it's going to get displaced. There's going to be, the Internet of Things is going to take over. Blah blah blah. Digitization was going to take over. The good news is none of that occurred en masse. We still, North America book sales is probably still about 70-75% printed books, and the rest is audio and e-readers. But it set us on a path at that point to say we have to diversify because we're
Hmm.
not, as much as we love print and we love books and we love storytelling, uh, this mission is about more than that product line, right? And so we said we need to diversify, but we were gripped for, I'm going to say, a decade almost of how to diversify, what to diversify. And so we started some different businesses and we got into some different things. And so there was this motivation to try and get some feelers out in diversification. None of which really hit well, and some worked for a while, but it really came back to what is the thing that differentiates our company. And so that's the classic strategy, is to say, if you before you start diversifying, figure out what you're really, really good at that nobody else can do, go do more of that, right? And when we went through that exercise, we realized, well, we're kind of the poster child for employee ownership and EOT. And so what does that look like in our context to diversify on that platform? Well, we didn't want to just go out and buy businesses for the sake of diversification that we knew nothing about. And so we stepped back and said, well, it shouldn't be Friesen's, because we didn't want to apply too much risk to our current stakeholders of Friesen's Corporation. And so we said, we're going to do is we're going to build a company that, if we believe that employee ownership is one of the sole reasons, or the primary reason why we still exist today, and if we think employee ownership has helped us continue to have all this economic spin-off in the local community, and we know that all these sellers of businesses are out there now looking for buyers over the next, you've seen all the stats on the next 10 years, there's going to be this massive transaction happening. So we said, what's our role in all of that? Okay, well, we don't have a lot of employee ownership happening in Canada, and we think we've got a better model. We think, not for every company, but we think we got a superior model to sell into private equity or sell into a major consolidator or large competitor, those types of things. And so we said, what does that look like? And so that's where Tallgrass emerged. And the idea was we set up a separate entity, and that's why we're not, in all intents and purposes, Tallgrass is Friesen's, but we created a separate entity with the intention of essentially putting some of Friesen's capital to work. And so we have the great benefit in our company of having some surplus capital. Don't tell anyone. But we are now went back to our employee owners and said, this is what we'd like to do. We'd like to go out into the marketplace. We'd like to find steady, stable companies with proven track records, where the seller needs to exit, and the seller is motivated to try and maintain some of the legacy that would come from selling to employee owners. And so what we're going to do is we're going to overcome one of their big obstacles. And so at that point, if you were an owner and you went into your bank and said, I want to sell my business to my employees, the first thing your banker says is, great, do your employees have any money? And the owner says, no, they do not. And so then the next conversation is, well, you're going to be prepared to finance the entire deal, or a majority of the deal. And even the most generous owners at that time have a second thought and start peeling back to say, that's an awful lot of risk for me to personally carry and for my family to carry going forward. And that killed a lot of employee ownership options right at the bank, right at the lending desk. But at the same time, there was also no help. Like there was like no structure in Canada to really facilitate that type of transaction. So your owner is also looking down the pipe and saying, I got to build all this stuff by myself. I want to try and create it all, right? Just like the Friesen family did over time, but that took decades, right? And so we said, A, we think we know how to set this stuff up. And B, we've got some cash that we're willing to invest. And so those are the two things that Tallgrass does, is it finds these stable, long-term, steady. We're not interested in startups or rebound projects or any of that stuff. Steady, long-term companies. And we say what we're going to bring to the table is patient capital. So we're willing to invest with zero return in the first couple of years. Simply, we're going to put some cash in to help de-risk the financing for the owner, and we're going to help set the stage for how to structure the business. And so part of that was we went to we joined up with a merry band of folks on the Employee Ownership Canada, and we went and advocated to Ottawa to set up the legislation. And then B, we got to work to say if we needed to share, essentially replicate the Friesen's model in another company, what would it look like? And so we started to build out the framework of what that would, how that would look and what it would be. And so that's essentially what Tallgrass is we find a good company, we put some cash in, and we help show the path to EOT. And Tallgrass takes a minority position in those companies. And from our existing stakeholders' position, what that is meant to be is supposed to be a long-term, gets back to that long-term diversification strategy, which is we're going to take some cash and we're going to invest into businesses that are not in our industry. And over time, it's going to create this passive income stream that is widely diversified. But in the meantime, while we're putting that cash out into the world, we're not expecting huge returns in the short term, but we're going to have a huge return on social impact.
Yeah.
And so you can imagine we have an employee owner council. It's about, if everybody shows up, they're about 10%, it would represent about 10% of our employee owners, total employee owners. So I meet with them a few times a year, and we kind of talk shop about, hey, what are some of the strategies that we have coming up in the company, and I want them to give feedback on. They share some of the issues that they're seeing on the shop floor, maybe. But I went to this group and I said, okay, guys, this is the big hairy idea that we'd like to tackle. And quite frankly, I was bracing for people to say, what are you, nuts? This is our capital. You're putting our money at risk. And I was just so positively surprised when they came back and said, listen, we wouldn't be where we are today if it hadn't been for somebody paying it forward to us. And so if the Friesen family hadn't set us on this course to employee ownership, and if this company hadn't taken the steps that they've taken to make sure that we are participating in the proceeds of the company, we wouldn't have any of this. And so it resonated with them that we would now go out and do that for someone else.
Right. Because on the surface, it looks a little bit like these are very, very different companies. Like, how are they related? But it's the whole story again, and how it's all connected.
Yeah. So you got to imagine our long-term vision for Tallgrass would be this family of employee-owned companies that their core purpose or connection is through how they're owned. And that you might end up having a construction company tied with a manufacturing company, tied with an engineering company. But at the core is sort of those principles and philosophies of how ownership happens in those companies. And at the end of the day, we've got visions of billion-dollar employee-owned conglomerate that now creates that sort of stability of diversification inherently in going out and finding. So we're not super specific on the industries that we're focused on. We're the main indicator for us is we're trying to find owners that are aligned to the vision.
Right.
And so
Canadian. It's a Canadian
owners that are aligned to the vision. Yeah. And so that's usually the greater guide than being industry agnostic or and so that's the mission. And so the other piece, I don't know if to just give your listeners some context. So we've been at this for a while with Tallgrass, and yet wheels really we didn't get wheels up until the legislation took hold. And so that was early 2024. And it's taken a long time in 24 to get the message out. So we were trying to do awareness and build up and whatnot. And then 2025 hits, and the world all gets topsy-turvy from a trade war and tariff threats and whatnot. And so as you'll know from your position as well, that caused a lot of M&A to just stall in 2025, and people are pulling their chips off the table. If you had any U.S. exposure, you probably ran for the sidelines. but now 2026, we're starting to see some more interest building, and more conversations are happening. And so I'm very hopeful that, the for our stakeholders' sake, one of the things that we're working through some due diligence with a couple of firms right now. But what we want to do is really prove out the model. That's the first objective, is we want to prove that we can, A, find them, B, we can actually complete some transactions. And imagine our first phase of Tallgrass would be like proof of concept, that would say, A, the model works, people are willing to sell into it, and the participation is working. Then we really want to hold it out there to say, boy, is this something that Friesen's alone will continue to be the sole investor in, or is there an opportunity for that to become a vehicle,
more, right?
Become a vehicle for other capital to come into that space? But it is a very unique investment model, because there's not many investors out there. That we're almost trying to be the opposite of your typical
PE,
private equity, right?
Yeah.
Private equity is trying to liquidate in 5 years. We're saying we're going to invest, and we're not expecting a return in the first several years. And so we're very much trying to be sort of an obvious contrast to the investment models that are out there today, but very much looking forward to proving it out, so that we can demonstrate to other social impact type of investors that this is a strong opportunity for them to apply their resources to.
Well, and of course, the legislation, we're recording in March of 2026. And as anyone who's already been regularly listening to the podcast or watching on YouTube knows that I batch things out in advance, because of course this is not my full-time operation. So this may not be going live for a few months yet, and we're sitting on pins and needles hoping that the government's also going to extend the capital gains exemption. Yes. Yep. So I don't know if we'll have any news by the time this goes out or not, but that's also kind of a little bit of a cloud hanging over this structure. At least it gets more people interested in looking at it, and there's incentive there. Yeah.
Do you want a little backstory on that one?
Yeah, so sure, of course.
I was in Ottawa 2 weeks ago, and we had one-on-one meetings, both in the PMO with some of the PMO advisors, senior advisors, and in finance. And so I can tell you, I'm going to make a prediction here, because it's going to air later. And by the time it airs, I think we're going to know whether it was included in the spring economic statement or not.
Fingers are crossed. Yeah.
I have a high degree of confidence that it's going to be included in the spring economic statement. I hope I'm not disappointed by that prediction, but we left Ottawa. There's a handful of us that went to Ottawa for these meetings, and we left there feeling that odds were quite good that we're going to hear some positive news in the spring economic statement. And so
that would be great.
I'm hopeful, but now you've got me on record that you can prove me wrong if this thing airs.
Become a meme.
Yeah, exactly. Yeah.
If only I knew how to do that. But that's okay. Well, I'm sure there's plenty more to digest and to talk about. But I'm gonna suggest that we do head down the path of sharing with us one piece of fun, frank advice, only so that listeners will want more, so we can learn more and get more, but not keep you here too long. So do you have a piece of fun, frank advice you might leave for the Self-Made Nation?
Well, your question was, what would you tell a founder who's proud of what they've built but anxious about letting go? And so I don't know if it's specific to EOT, but this has been a learning experience for me, because I'm a manufacturer, printer, I don't have an M&A background and finance background and whatnot, but I have been meeting with, I won't say hundreds, but a large number of owners
Mm-hmm.
And so I actually understand this quite intimately already, this conversation of people that are anxious about letting go and unsure. And so I think one of the maybe interesting perspectives I'd share with somebody in that part is, don't let your business become, the 45-year-old that's living in your basement. If you really want to do well for your business, you have to build it to something that doesn't need you going forward. And I think that's important for any sale, but it's
Mm-hmm.
especially important for an EOT, because in an EOT, you're really relying on your bench strength to rise up to lead the company. So
Mm-hmm.
you're not selling to another company that's going to parachute in leadership. You're really going to rely heavily on the leadership that exists today. And so making sure that your team is ready to lead your company is really, really important. And it's the hardest thing for owners to do, is get out of the way while they're still part of the company, so that the company can grow and be ready to do it without you. But don't let
Mm-hmm.
don't let it be a 45-year-old in your basement. Maybe that's the
Yeah,
advice I.
stop serving cheese. You have
Exactly.
to be of a certain cohort to
Yeah.
know that reference. So how would a listener get in touch with you if maybe if they wanted to investigate the services through Tallgrass or learn more about reasons in the EOT? Where can they find you?
Yeah, so they can find information on tallgrassfund.ca. That is our dedicated Tallgrass page. They can also come through friesens.com, www.friesens.com. Those are two websites. Feel free to come through Friesens, because then you can learn about everything else that we do. But
Hmm.
there's both sites actually have some really good content with regards to the Friesens history, and also sort of what we've learned in sort of the more recent time about how EOTs are structured, and some of the issues that people would navigate through. So it's there's some I think there's some good content in both of those, but ultimately you don't necessarily need Tallgrass to lead you to an EOT. And so that's where I would also direct people to Employee Ownership Canada. There's just a robust amount of resources there that people can learn from, and connect with all sorts of really talented people. We're a small group.
Hmm.
In the whole EOT movement or employee ownership movement in Canada, still a relatively small group, but
I've had almost all of you on the podcast at this
yeah,
point.
yeah, yeah.
So look back on
But
some previous episodes, you might
yeah,
to yeah.
but I'll tell you, every one of them will take a call, and we'll
Mhm.
give a little bit of time where we can, and so don't feel like you have to try and learn it all on your own. I think there's good people out there that would be glad to pick up a phone call, have a Teams meeting or a Zoom meeting, and help out where we can.
Been great to have you on the show here today, Chad. Thanks so much.
Right on. Thanks for allowing me to come on the show, and I look forward to it. And hopefully, I'm right on my predictions.
Yeah, same here.
All right. Thanks, Colleen.
You're welcome.
Have a great day.
A fascinating look at the Friesen Corporation and a powerful look at employee ownership, how employee ownership can be more than just a structure, strategy for community wealth, long-term resilience, and legacy. Self-Made Nation, thank you for joining us today. And if today sparked any questions for you and your exit, love to chat with you. If you're thinking about what you'll need financially, how to protect your people, your values, and what a true cash-rich exit or transition could look like for you, feel free to reach out to me, Colleen O'Connell-Campbell on LinkedIn. For a one-on-one wealth gap analysis, you can email me at colleen.campbell@rbc.com. And if you enjoyed this episode, please consider leaving a 5-star rating and review. Subscribe on YouTube. It helps more founders find the show and have their best exit, a cash-rich exit. Thank you for listening. I'm looking forward to welcoming you back again soon. I'm Colleen O'Connell-Campbell, Wealth Advisor at RBC Dominion Securities. TTFN. Ta-ta for now. Quick note, all opinions expressed by me and any of my guests are solely their own opinions and do not reflect the opinions of RBC Dominion Securities. This video is for information purposes only. Before acting on anything you hear or see, consult a qualified professional. I am a wealth advisor with RBC Dominion Securities, a member of the Canadian Investor Protection Fund.